have not a respectable recovery at this point yet, and I think that's what was a little bit disappointing this week. As you noted, a number of companies released earnings, and if you could sort of pull together a few things that seem to run through GE, Microsoft, IBM, and Intel, it's that their sales and earnings and in the company's guidance, they say that operations have stabilized, business is stable, but they don't see an improvement either in the economy or in their own business over the next 12 months or so, and we keep looking for that, but that hasn't shown up yet. But I think there are a couple of positives really now which will help generate returns for the market over the next year. One of them is valuation. I think the majority of stocks are a good valuation. And the other one is the economic stimulus plan, which will improve the economy and improve after-tax returns, particularly if we get some dividend taxation relief.
Well, we would value hearing your current recommendations.
To revisit one that I've talked about before, and I own all of these companies through my mutual fund, Cendent is a company that has also not had a respectable recovery, despite the fact the company puts one foot in front of the other over the last couple of years. It is in the travel and lodging business, which is not attractive right now, but really the company is selling at 8 times this year's earnings. It's generating about $2 of cash flow per share, and it's really, I think, a very inexpensive company. I think this year maybe it's time. AOL Time Warner is another one, which I think the price does not reflect the real earnings power of the brands and franchises that it owns, and of course it's had a whole host of problems over the last 12 months, but the news is at the margin starting to turn positive. And finally, Honeywell, one of the current dogs of the Dow, a higher yielding stock at 3%. I think that if capital spending eventually picks up and the economy recovers, we'll get a better multiple on higher cash flow and earnings, which I think are really troughing here.
All righty, as usual, no guarantees from the management, but as we move through what we hope will be a happier new year for the economy and for investors, our ever-sympathetic group therapy counselors are always happy to hear from you here at this program's exclusive and ever so easy email address, lou@cnbc.com. Madonna, that means you. And now let's go over and meet tonight's special guest, Neil Hennessy. Neil, welcome. Pleased to have you with us tonight.
Thank you, Lou.
Neil Hennessy believes in doing it by the numbers, and his disciplined, quantitative approach has produced well above average numbers for shareholders in the 4 mutual funds he runs as president and portfolio manager of the Hennessy Funds. With his flagship Hennessy Cornerstone Growth Fund, despite a tough December, off to a good start this year and still showing annualized growth during the 3-year bear market of better than 5.25%. So, Neil, what are you doing right?
Well, we're just sticking with the strategy. As you know, it's highly disciplined. It's non-emotional. We let the companies come to us. We hold them for a year and then refresh, and that's why we've had the returns that we have.
Well, I have nothing against discipline. What is your discipline?
Well, in the Cornerstone Growth, it's actually, we screened 9,700 different companies. With the first screen last year was to have a market capitalization of $172 million. The second screen is we want to make sure that the price-to-sales ratio is 1.5 or less. The third screen is we want to make sure that the earnings are higher than the previous year. And then our fourth and final screen is we buy the 50 companies that filtered all the way through that have the best relative strength over a 3, 6, and 12-month period. So it's value plus momentum.
Do you always hold them for a year?
Well, we have a rebalance between October or in February that we can refresh the portfolio only because our portfolio is public information. Everybody knows the stocks we own, they know the shares, and we don't want to be front-run.
How do the 4 funds differ?
Well, the first 2 funds that I started back in '96 and then '98 utilize the dogs of the Dow investment theory, which is really buying the 10 highest yielding Dow Jones stocks in equal dollar amounts and hold them for a year, rebalance, so on and so forth. Our third fund is a value fund with the last criteria being we buy the 50 companies with the highest yields, and then our growth fund.
Based on the number crunching you do, which of your holdings seem most attractive to you right now?
Well, from a sector standpoint, you know, I still like housing. I like retail. Housing is good not only in the new building sector, but existing homes. If you look at different companies, they all have, most of them have mortgage arms, and with interest rates 40 years low, that's going to be still a good business. Retail, I think, with what's going on politically, it's going to be.
Do you have an example within the field that you like?
In housing, NVR not only builds new homes, they sell the new homes, and they finance the new homes. And the stock has done very, very well over the last couple of years. And you have to remember, these companies came to us. We didn't go to them.
Go on. That's one.
Oh, that's one. On the retail side, you know, there's a couple different. Retail's so huge, Lou. One is Tractor Supply. Most people don't understand or don't know about Tractor Supply, but it's a retail farm outlet type of store, and that's done extremely well. Another one that we own
you have
is.
to tread lightly with that one, though.
Yes, in wet weather. But in another retail stock, which is completely different, would be like Ross Stores. And Ross Stores, you know, when we started buying that, we bought it with a price to sales ratio of 0.91 and now sells at 106. So there's a huge gap in retail but I think it's going to do very well.
When you say you rebalance once a year, might a stock reappear the second year?
Yes, it very well could. For a couple, and NVR is a classic example of that. From the standpoint, not only was their price of sales low. When we started buying it, we paid 0.59 on a price of sales. Now it trades at 0.83. The second thing is their earnings were going up, and the momentum of the stock was going up. So that stayed in the portfolio. Same with a couple other stocks.
Neil, your value methods lead you often to dividend-paying stocks. Is that going to be helped by these proposed tax code changes?
Absolutely. You know, if this goes through, which I think it will go, the elimination of the double taxation, that is going to put a tremendous amount of money into circulation. The New York Stock Exchange companies that are listed there pay out approximately $250 billion a year in dividends. And that's either going to be spent, saved, or invested. Either of the three ways is going to be good for the economy.
What do your methods tell you should be sold these days?
Well, we don't go with different sectors or say a good sector is a bad sector, because each portfolio is different. The growth is going to be different than the value. But what you have to do is be selective within the sector that you actually are buying into. I mean, a sector, if you want to just look at an index, last year the NASDAQ was down 31%, and Ross Stores was up between 35 and 40%. So it's just, you know, it doesn't matter what sector you're in, you just want to be selective within it.
Neil, nobody gets away scot-free in this business. I got some emails about you this week. Here's one of my favorites, because the guy says, I like his fund a lot. And he says a lot of nice things about you and your methodology. He says he's adopting it himself, but then he has a complaint. He says, would you press him, ask why his Cornerstone Growth Fund expenses are so high? He charges 1.11% for a fund that is computer-driven and buys in once a year. Is that too high an expense ratio?
No, actually, that's a very good question, and I get it all the time. Simply, you ask any money manager, ask Barbara, actually managing the money is the easy part of the business. Managing the mutual fund company, well, it is. Managing the mutual fund company for the benefit of shareholders takes a lot of time and effort, and it's a time-consuming job. And that's where, and with the new regulations coming out, it's not going to get any cheaper for the investor out there with the Sarbanes-Oxley and new regulations. So if we can hold our expense ratio at the 1.1, 1.2 and give the returns that we do, I don't see any reason for somebody to complain.
For no fee at all, let's turn to our panel, starting with Bob Stovall.
Yes, Neil, you do a quantitative approach, namely you just look at the numbers. You don't talk to the management, you don't investigate the product. Is that right or wrong?
Correct.
And if that's the case, do you find any problems that develop along that line, that you get blindsided, that the numbers don't pre-advise you of something that might happen to the product line or the management stature?
Well, what it might, you know, sometimes lack in, you know, in some of the quantitative, it's made up in the discipline of it. It's going to let them spend a little bit more money, and who doesn't like checks in the mail?
How do you expect the economy and the markets to be different over the next year or two than they've been over the last?
Well, I haven't looked at 1 to 2 years, but I do look out 5 years, and I think you can reasonably see the Dow Jones Industrial Average at 15,000 for 3 specific reasons. Number one, I think that corporate earnings are going to be better than what people actually think, just because they're lean, they've slimmed down, they've cut employees and cut costs, and any little increment in revenue is going to fall to the bottom line. The tax proposals, second by Bush, and the elimination of double taxation is just going to put a tremendous amount of money in people's hands. And number 3 is, if you just look at history, which you've always done, Lou, is go back to like 1983. The markets averaged 16% a year up through last year, the Dow Jones. If we just average 11%, 2/3 of that, you're going to be at 15,000. So I don't see any problem looking out 5 years, and I just wish the investors would look out 5 years and not day to day.
Thanks very much, Neil Hennessy.
Thank you.
We want to check with you in less than 5 years, and hope your optimism is correct, that we do have to stop. Thanks to our panelists as well. Next week, as part of our continuing effort to give you the widest possible array of info.
Thank you for watching, and remember to like, comment, and subscribe.